Hello, and welcome to the last video from Fin Know-how in the series where we took a closer look at the various financial statements. In the last two lessons, we discussed balance sheets and income statements, and in this video, we focus on the last of the three core financial statements, namely the statement of cash flows. While the income statement showed profitability and the balance sheet showed the financial position of the company, the cash flow statement reveals the actual movement of cash, the lifeblood of any business over a period of time. So I'm going to start with the discussion of why we need a statement of cash flows. So since a balance sheet provides a snapshot of what a company has and how it is financed, those assets are financed. And an income statement already tells you about the profits that were generated from deploying those assets. It seems very natural to ask, why do we need a cash flow statement? Turns out that the need for the cash flow statements comes from the use of the accrual accounting methods. You might remember in the discussion, the last two videos, we talked about accrual versus cash-based accounting. Most businesses use accrual accounting where the system records income and expenses when the transaction occurs, not necessarily when cash changes hands. So a transaction can occur, and even if the cash associated with the transaction has not occurred, in the accrual accounting system, the transaction is recorded as being complete. One of the benefits of doing that is that it records the actual business activity and separates the payment of cash from the actual event of the transaction. Okay. The downside, of course, is that the cash activity is not directly visible in the income statement. If you notice, it just shows the sales, even if all of the sales were on credit and it's showing up on the accounts receivable, it's not showing up on the income statement. From the income statement alone, you cannot figure out how much it was credit, how much of it was credit sales, and how much of it was cash-based sales, right? So that is why we need a separate statement of cash flows to track down the real inflows and outflows of cash. And again, that is needed because the accrual accounting system separates the transaction and the cash flow when it records the transaction on the income statement. Okay. And of course, by extension, businesses that use cash-based accounting don't need a statement of cash flows. Their income, by virtue of adopting the cash-based accounting, already reflect cash movement. Okay? So again, in cash-based accounting, transaction and movement of cash happen simultaneously. Only when both happen is it recorded as a transaction. In accrual basis accounting, the sale is consummated, and as soon as the sale is consummated, it's recorded on the income statement, even if the cash for that transaction may not occur at the same time. Okay. All right, so with that background, let's take a high-level view of the format of the cash flow statement. So what a cash flow statement does is to trace the cash impact of all transactions recorded in the income statement and balance sheet. So every transaction on the income statement and balance sheet has got a cash implication. The statement of cash flows makes sure that all of the cash implications are picked up in the statement of cash flows. So the structure is relatively straightforward and simple. It starts with the cash that is recorded on the balance sheet at the beginning of the period, at the start of the period. It's called the beginning cash. Then it looks at all the events that occurred during the year, which led to additional cash coming into the business, all the cash inflows, if you will. It also looks at all the events or the transactions that cost cash to flow out of the business. So it subtracts all of the cash outflows. So if you take the beginning cash, add in the cash that came in, take out the cash that went out, you are left with cash on hand at the period end. If the ending cash is higher than the beginning cash, you would say that the business generated a positive cash flow during the year, meaning that the business added to its cash balance that it had at the beginning of the year, and so it ended up with a cash balance at the end of the year, which is higher. Um, if the cash balance is lower, then the business generated negative cash flow, meaning that the activities of the business cost more outflow than inflow, so the ending balance of cash is lower than the beginning balance of cash. Now, when the ending balance of cash is lower than the beginning value of cash, that deficit may need to be covered in the form of additional capital. So it may have enough of a cash balance to operate, but the fact is that the firm is losing cash out of the business, and that needs to be tracked and monitored. Now, where does the cash? So if we notice here, we said cash received, cash spent. So where is this cash coming in from? How do we know what transactions are triggering the inflow of cash and what transactions are triggering the outflow of cash? So we're going to look at the two main sources where money comes from. One is operating activities. So when a company sells its product to customers and revenue is generated, and it collects on its receivables, that is the temporary short-term loans that it has extended to its customers, and all the other day-to-day activities that the company is involved in, the operations of the company, those are the things that can drive cash from operating activities. This cash may be positive or negative. If the business is not at all profitable, the cash from operations may be negative. If it's a successfully operating company, the cash from operating activities is likely to be positive. The other way in which cash comes into the business is through the raising of cash. If a company borrows funds from a bank, that brings in cash in the business. If the company raises capital from an investor or multiple investors, that is a source of cash to the business. Okay, so we're drawing a distinction between two types of activities here. One is operating activities, and the other is financing activities. Actually, there is one more that you ought to think about, because if you're making investments in plant and equipment or investments in long-term assets, that is also an outflow of assets. But if you're looking purely from a source standpoint, you're looking at the profits of the business as well as the financing activities. Now, where does the money go? The outflows of the business happens when you're paying employee salaries, you're paying for raw materials, you're paying for other materials, you're paying for rent and utilities and so on. All the operating costs, operational costs, including cost of goods sold, that is an outsource of outflow of funds in the company. Similarly, just as financing activities can be a source of cash, the need to pay debt, interest on debt, the need to repay debt, the need to distribute dividends to shareholders, all of those are the flip side of the financing activities, which cause money to go out of the firm. Right? So financing activities can bring in cash, and other kinds of financing activities can take cash out of the business. The third place where money can end up leaving the company is when the cash is used to buy long-term equipment like machinery or equipment and buildings and technology and so on. So again, these are not the operational expenses, you're talking about investments in long-term assets of the company, those assets that generate revenue and profits over time. And finally, income taxes are another source of outflow for the company of cash. Okay, so with that detail, let's look at how the cash flow statement is organized. Let's look at its format. As in the case of an income statement, it covers a period of time consistent with that of the income statement. So if you have an income statement which says the income statement from January 1st, 2024 to December 31st, 2024, the statement of cash flows will map to that time period. And consistent with what we just discussed, you start with the beginning cash, and then you look for cash from operations. The cash from operations includes, in addition to income statement, I missed the inclusion of income statement here. Technically, it should say income statement, income from net income plus change in working capital plus adjustment for non-cash expenses like depreciation will lead you to cash from operations. Okay, so your net income is a source of cash. So if you take the initial balance, the net income provides a source of cash, but I have to make adjustments for the fact that not all of that net income is in the form of cash. It could be receivables, it could be payables, and so on. Right? So I make adjustments into the working capital, and I then make adjustments for non-cash expense, because we know that embedded in income statements are non-cash items such as depreciation. So I make adjustments for it. So that gives me the cash from operations. Then I have the investments in long-term or fixed assets. Then I look at my financing cash flow. How much did I raise in additional borrowing? Or if I did not raise capital, in fact, if I paid back capital, this net borrowing F will become negative. Net proceeds from the sale of stock. So if I sold stock and raised capital in the markets, that would be a source of cash. If I did not raise capital but paid out dividends, then this would be a negative number. So I have the beginning cash, I have cash from operations. And again, I'll repeat that I'm missing the income, net income piece of this. So I have those two plus investments in long-term assets, which is an outflow, financing cash flow, which can be a positive or negative depending on what activities you're dealing with here, leads us to the closing cash balance. So the key elements are beginning cash, cash from operations, investments into long-term assets, and financing cash flow. If you add them all up, you get the closing cash balance. And the difference between A and I will tell you if the cash flow generated during the period was positive or negative. If it is positive, I will be greater than A. If it is negative, I will be less than A. Okay? So this is what the standard cash flow statement format looks like. Okay? All right, so that gives you an overview of the statement of cash flows. And honestly, there isn't much more to it than that. Of course, there are tons of details that's probably too much for this discussion. But at a high level, this captures the essence of what a statement of cash flow is. But before I wrap up, though, I wanted to bring together our discussion so far about income statements, balance sheets, and the statement of cash flows, especially because these statements provide different perspectives. Like I said, it provides different views of the business, but they're also connected. So I'm going to explain that connection using a few examples. The first example that I'm going to use is the connection between inventory, sales, and receivables. Okay. In fact, I would say payables too. Okay. So when let's say you are a shoe manufacturer, you have shoes sitting in your inventory, shoes that have been manufactured and ready to go. When you sell that shoe, that the sale price of the shoe will show up as revenue, and the inventory of the finished goods that from which you source the product that you just sold will move from that. The value of the shoes that are sold will move from inventory to cost of goods sold. Okay. because until then, the cost of goods sold is not recorded. It is only recorded when the good is actually sold, that the shoes are actually sold. So until then, it sits on the balance sheet as a finished good under inventory. When the transaction occurs, the revenue gets recorded as well as the cost of the inventory um, is picked up in the in the cost of goods sold. Now remember that the transaction may not require cash to be paid at the time of the transaction. So let's say the shoe is sold, but the payment is going to come in 30 days from after the transaction. So you now have to record that transaction as a sales revenue, but also you have to create an accounts receivable to denote the fact that the payment has not been received yet. Okay. So we went from inventory to revenue to cost of goods sold to accounts receivable. And when this accounts receivable gets paid, it converts to cash from operating activities. So you could see the connection from balance sheet to income statement to the statement of cash flows, because if you remember, in the statement of cash flows, we have a line item which talks about the adjustment to working capital. If you remember here, working capital, right? And this, when your receivables reduce, you are affected because receivable is a current asset and working capital is current assets minus current liabilities. The working capital piece changes, and hence the cash from operating activity is also impacted. On the flip side, when an expense is incurred but not yet paid, it becomes an accounts payable. Okay, liability on the balance sheet that increases current liability by the amount of the increase in the accounts payable. When that expense is actually paid, the account payable then goes away and it converts to a reduction in cash, because now the cash went out in closing out the accounts payable, and that causes a reduction in the cash from operating activities on the statement of cash flows. Right. So as you can see, um, there is a strong connection between what's on the balance sheet as a sale occurs, how that converts into sales, as well as the accounts receivable, and how when that accounts receivable were created, it changes. It reduces the cash and operations from operating activities, but when it's paid back, it brings it back up, right? So now on the other side, the expense side, when a payable is created, it creates a liability, but when it is paid out, then it requires cash to flow out of the business, and it reduces the cash from operating activities. Similarly, I'm going to use another example, and then this time it relates to certain balance sheet items. When you acquire a fixed asset, what happens is that the money for that fixed asset is going to come from the cash that's sitting on the balance sheet. Right? So the acquisition of the fixed assets will cause the cash on the balance sheet, the fixed asset line item to increase and the cash line item to decrease. Now, when you have a fixed assets, we know that we have to have depreciation. So that depreciation will show up on the income statement because that is treated as an expense. And it will also increase the accumulated depreciation on the balance sheet, bringing down the net book value of that fixed asset. Okay. So again, within a fixed asset transaction triggers a bunch of activities. One, it takes cash from the balance sheet, moves it to the fixed asset line item. The moment you have a fixed asset line item, it triggers a depreciation expense on the income statement, and the depreciation expense over time starts to add up to the accumulated depreciation item on the balance sheet, which then reduces the value, the book value of the fixed asset from its gross value to its net value. Because the cash on the balance sheet must be so if a cash on the balance sheet as of today must be consistent with the ending cash on the cash flow statement. So if I were to take at the end of the year, the a key connection between the statement of cash flows and the balance sheet is that what's on the balance sheet at the end of the year must be consistent with what's recorded as the closing cash or the ending cash on the cash flow statements, right? Because at the beginning of the year, you had the beginning cash, whole bunch of operating, investment, and financing activities happened. That would cause some cash to go out of the business, some cash to come back into the business. But net net, at the end of the period, what you say on the statement of cash flows as your ending cash should be consistent with the cash that's reported on the balance sheet on the closing date, on the last date, as a snapshot of in time on the balance sheet. The other piece of the puzzle here is that when you increase borrowings on the asset side of the balance sheet, it increases cash because cash just came in. But that borrowing caused your liability to go up. So because of the balance sheet equation, the increase in cash must exactly equal the debt amount that was raised or the borrowings that were made. Similarly, when a company decides to pay dividends using cash on its balance sheet, it's going to reduce the cash on the balance sheet. And on the other hand, if you sold stock and raise capital, that's going to increase the cash, but at the same time increase the shareholders' equity as well. Okay. So the last two slides gives you some examples about how the financial statements are connected. There are many, many more linkages. This is far from complete, but what I wanted to do is highlight how these various decisions that are made, various transactions that are completed, ripple through the financial statements and the overall, and it reflects the flow of activity within an organization. Again, this list that I just went through is by no means exhaustive, but hopefully it highlights how closely the financial statements are linked. Again, hope you found this discussion useful. As always, happy to answer any questions you may have. Please feel free to reach out. Thank you for your time and look forward to seeing you in the next lesson. Thank you.